Good morning to everyone, and thank again for joining us for Tecnoglass's three-quarter earnings call. Start with the highlights. Revenues up 13% to a new record of approximately $240 million. This was primarily driven by very strong residential performance, up to 25% year over year. And if you recall, when we spoke during Q2, there was a record level of orders that came in through June. So naturally, those are getting invoiced in Q3 and Q4. Very excited about that. Commercial performed strongly as well, up mid-single digits to approximately $128 million. As opposed to the last couple of quarters when we had some headwinds on the gross profit margin side, this quarter we started to see gross profit margin picking up. This quarter up 300 basis points approximately to 46%. And if you recall, sequentially Q1 was at 39%. Then we gained 200 basis points to approximately 41%. So a nice pickup of 500 basis points sequentially to 46%. Adjusted EBITDA up 14% to $81.4 million, up from $71 million. Driven mainly by the pickup of gross profit and obviously by the record level of revenues for the quarter. Along with that came very strong operating cash flow of $41.5 million, which is driving leverage to an all-time low of 0.01 times for the quarter. Finally, record backlog again, north of $1 billion, up 25% year over year. So the same tendency continues and backlog continues to go up. Now building not only 2025, but a good portion of 2026 as well. So nice segue to move into backlog, which as I just mentioned, expanded 25% year over year. This gives us a lot of good visibility for obviously the rest of the year, most of 2025, and now building into 2026. Pipeline continues to perform well, so we expect the tendency to continue as far as backlog growth. And this is driven by favorable demographics. Florida continues to perform well. A lot of people moving still to the Sun Belt states, which is where we are the strongest, so that continues to play in our favor. Moving on to single-family residential, as I mentioned earlier, this was probably the highlight of the quarter, up to a record level of $110 million, coming from quarters of $85, $90 million. So it was a nice pickup sequentially. And that was driven by the incremental level of orders that we saw as of the end of Q2, partially helped by the expiration of the sales tax waiver in Florida. So there was a partial pull forward effect on that respect. With the interest rates situation and expected interest rates coming down, we continue to kind of be very bullish about what's to come there, especially as in regards to the geographical expansion, not only the Florida market, which continues to perform strongly, but also the penetration into the vinyl segment, which will create a much larger target market for us. Going into the revenue dynamics, I just mentioned all-time high, $238 million, up from about $210 million last quarter. Residential up 25%. Commercial did fairly well, up mid-single digits year over year. And we expect that to continue to be the case based on how we're seeing the rest of the year. Moving on to our adjusted EBITDA. There were a couple of tailwinds that helped us achieve 14% growth year over year. Number one, pricing. We adjusted some pricing in Q2, which is now translating into the P&L for Q3. So that's helped and is expected to help along the way for Q4 as well. Better mix with the incremental orders on the single-family residential side where there's no installation. The overall mix of the revenue composition was favorable to margins and therefore for EBITDA year over year as well. That was partially offset by higher salaries and expenses. As we talked earlier In Q2, salaries were adjusted at the beginning of the year by about 12% for the remainder of the year. So now we're absorbing those, and obviously with the higher capacity and incremental sales, the under absorption is going down, and obviously we expect that to continue to be the case as we move forward. From a cash flow and leverage perspective, as I mentioned earlier, it was a strong quarter of cash flow, reaching about $41.5 million of operating cash flow and almost $20 million of free cash flow for the quarter. We've spoken about how we expect CapEx to trend down, especially in the next year and beyond, given the fact that we have quite a bit of operational capacity to continue growing into. So the tendency to continue generating cash flow is expected to continue the rest of the year as well. And with that, obviously, we've been able to repay quite a bit of debt, almost $50 million that we paid altogether year to date. And that brings our debt level down to $125 million against a cash balance of roughly $123 million. So our expectation is for us to end up the year on a net cash position. Finally, moving into our outlook, we are strengthening our outlook for revenues to a range of about $880 million to $900 million, which equates to a growth of 6 to 8%, which is, in a challenging year, we're satisfied where the levels of revenues ended up. And with that, we're also adjusting our Adjusted EBITDA upwards to a range of $270 to $280 million. That equates to gross profit margins in the neighborhood of low to mid 40s for the full year, and also expect CapEx to trend down as we execute on some of these past initiatives for growth. And with that, I thank you for joining Tecnoglass Q3 earnings call and hope to see you on the next one. Thank you.